Hi everyone, this lesson is going to be on repaying loans and short-term borrowing. So short-term borrowing. So you are charged a fee for the luxury of borrowing money. So this fee is called interest. Another unfortunate truth is that you will most likely have to borrow money at some point in your life, whether it is to buy a house, a car, or other big ticket items like washer, dryer, fridge, etc. A bank will offer you an interest rate for borrow based on several factors. These factors are where and how long you have been at your current job, credit debt and how it is managed, and other loans and debt that you may have. So for example, OSAP and a mortgage. So types of loans. Mortgages is one type of loan. That's when you buy a house, you take out a mortgage to pay. The banks need security to ensure that if you do not make your payments, they can take it back. So mortgages are considered long-term loans because they take so long to pay back. A loan is when you take out money, so it's less than a mortgage, and pay it back in a shorter amount of time. So if a mortgage is 20 to 25 years, a loan can be anywhere from 5 to 10 years. It's used for people who want to buy or pay for something and do not quite have the funds at the time. So this is for like buying a car, home improvements, or a vacation. All of these are just examples. A line of credit. Line of credits are also loans, but with a specific purpose. So a line of credit works the same way as a credit card. So you're given a credit limit. So say 10,000. This is how much you can take out. But you only pay interest on the amount of money that you do take out. So say you have a credit limit of 10,000, but you only pull out 5,000, then you only pay interest on that 5,000. And then overdraft protection. So this is used on your checking account. It is used when you withdraw more money than you actually have in your account. When this happens, you will need to make a minimum monthly payment if it is not paid back in full at the end of the month. So repaying loans. So amortize is the process of paying off a debt, usually from a loan or mortgage over time through regular payments. So when repaying a loan, the bank or lending institution will often provide you with an amortization table. This is a report that shows in a table all the information about your loan, including details of each payment. So let's look at some examples. What is the total amount of interest paid on a 5-year loan of $20,000 with monthly payments of $404.57? So we need to first find out, since it's monthly payments and it's over 5 years, let's find out how many payments there are going to be. So we take 5 years and we times it by 12 months. That gives us 60 months. That means there's going to be 60 payments of the $404.57. So 60 months times the $404.57, we get $24,274.20. So that's how much that we're going to be totally paying back, but we got to subtract the loan from it to find out how much interest. So I take that amount and subtract the loan of $20,000 that we borrowed, and what we're paying on top of it is that we're paying $4,000 in interest, $4,274.20. Example 2. So how much you can afford to borrow. So this is a rule of thumb. So never borrow more than 20% of your yearly net income. And then your monthly payments, so how much you're paying to paying back your debt should never exceed more than 10% of your monthly net income. So let's say if you earn $400 per week after taxes, what is your safe debt load? So amount you should not borrow more than. So $400 per week, there's 52 weeks in a year. So that means the annual income is $20,800. So we need to find out the annual income because we need it for the yearly net income. Then we could take 20% times the annual income. So 0.20 times that 20,800 gives me 4,160. So you should not be borrowing more than that 4,000. Then what is your maximum monthly debt payment? So we need to find out how much you make in a month. So 20,800, we divide it by 12, it comes to 1,733.33. So of that amount, 10% of it, we should not pay more than 10%. So 10% of that monthly salary is 173.33. So when we're making payments back for our debt, we should not be making more than 173.33. Example 3. So this is an amortization table. So the loan calculator spreadsheet, we've gotten the number of payments per year, the annual interest rate, the amount of the loan was $5,000, and the length of the loan is 2 years. So what is the amount of the loan? Well, the amount of the loan is $5,000. How long is the loan for? Well, it's for 2 years. And how often are payments? So the payments are monthly because it's 12 payments per year for 2 years. So it's going to be monthly. How much are the regular payments? So we could see in the table that the amount of payment is 221.60. So that's how much the monthly payments are going to be. What is the interest rate? The interest rate is 6%. And what is the cost of the loan? So the cost of the loan is the same thing as the total interest paid. So by the end of paying off this $5,000 loan, how much interest will be paying? And it's right here in the middle section, 318.47 is the amount of interest that we'll be paying back.